This is Professor Campbell with the Receivables TBS. So I have here data for Company A, and let's see, Company A, and we are going to do journal entries for various accounts receivables. Now these may be posted to a roll forward account or some other TBS type thing, but we're going to focus on the journal entries. So first item on 228, they sold merchandise to Company B in exchange for a note receivable. Okay. Note receivable, 10,000. And they had sales, 10,000. So it was 10%, 7 months. My cost of goods sold is 6,400. And we remove that from inventory. So generally on the test, you will have two entries when you sell something, when you sell merchandise, not service merchandise, okay? So the merchandise, they'll tell you what the cost of goods sold is. Usually it'll be about 60%, or they'll give you a figure. If they say don't record the amount, then you won't have that information available and you won't need to make that journal entry. But they will give you that permission. If they don't give you that permission, look for that cost of goods sold is 60%, 40%, whatever it is. Look for it somewhere in the problem narrative. Okay, 331. Sold merchandise to Company C, fair value of 7,200, accepted a note receivable, non-interest bearing. Okay, I'm going to abbreviate. Note receivable, 8,000. Sale, 7,200. Sales at the fair value of it. We have a discount on note receivable for the remaining balance. This is a balance sheet account, discount on note receivable, and this is a balance sheet account. So it's going to be a contra. So it'll have a net asset value of 7,200. Cost of goods sold, 5,000. Inventory, 5,000. Okay, so that's that journal entry. 4.3. Sold merch to Company D for 7,000. Terms 2%, 10 days, net 30, using the gross method. So in the narrative, you have to find out if they're using the net method or the gross method. So on 4.3, I have accounts receivable. Again, I'm going to abbreviate. And sales, 7,000, because we are on the gross method. My cost of goods sold and inventory, 4,700. $411 collected. Collected Company D in full, and it is within the discount period, so they would have paid 6,860, and I have discount on sales of 140, and accounts receivable is credited for the full 7,000. Okay. Note that this is an income statement account, so it's going to offset the previous sales once that discount is earned. That's our gross method. So we're going to have a contra account here in the sales. 417, customer return merchandise. Okay, return of merchandise is sales for 5,000, and accounts receivable credited for 5,000. The cost of goods sold Cost of goods sold is reversed. Oops. And inventory is replenished in the amount of 3,200. Okay. On 430. Okay. Sales. Inventory cost of goods sold is returned. On 430, transferred 50,000 of accounts receivable to a bank factor without recourse for a 1% fee. It's recorded as a sale. So I have cash, loss on sale, 500, and accounts receivable. We sold 50,000 of them. Okay. Note that no amount was retained by the bank. Nothing was retained by bank. So there is no due from factor. Okay. Because in this particular information, we did not have an amount that was retained. They just did an outright sale to them for $500. Okay. On 630, they discounted Company B note at bank. The bank rate is 12% without recourse. So this particular note receivable was then discounted. Okay. Company B note, okay, was dated 2/28 for 10,000 at 10% for 7 months. Now, if we do our timeline, 1, 2, 3, 4, 5, 6, 7 months, 2/28. So the first month is March, April, May, June, July, August, September. This is the entire note, and its value is 10,000 times 10% times 7/12. Interest is always at annual basis, so when we have a note that's shorter than annual, we have to allocate it. And that equals 583. Now they discounted that note at the bank on 630. So this amount here, they discounted it here at the end of June. So July, August, and September, the bank wants to know what the value is. So 10,000 plus 583 is 10,583 times the bank's rate of 12% times the number of months that the bank portion will be there. Oh, no, I'm sorry, 3/12. And that equals 317. And you subtract that from the 10,583. And that equals 10,266 proceeds. Okay. So the full value of it less the discount equals the amount that the net proceeds are going to be. What does my journal entry look like at 6:30? I received some cash. Sorry about that, 10,266. I have a loss on sale. I have note receivable of 10,000 to credit, and I have interest. It's my interest, and my interest is 10,000 times 10% times the part that I had. So it's 7 minus 3, 4/12. And that is 333. And that's interest income. Okay. So I take a look at what this total is, and I take a look at what this total is, and I calculate my loss at 67. Double check to make sure that my debits equal my credits. There's a discounted note, okay, at a bank rate of 12%, and the face value was 10%. Once again, the full face value of the note minus the time at which the bank is going to have that note equals your proceeds. Okay, and you're going to have a slight loss on that note. So you earned interest income up to the end of June, and that's included in those funds. Okay. All right. The last one on 9/30, Company B paid the note to the bank plus interest, so that they made a payment to the bank. What's the company's journal entry? No entry. Okay. The bank collected the note. Okay. TBS here for various receivables. And we can take a look at our journal entries, and the quicker we're able to do these journal entries, the easier the TBSs are going to be, especially if you would have had to post these journal entries to a roll forward for receivables and notes receivables. Okay, this has been Professor Campbell. Thank you very much.